Well, good afternoon, traders. And it's been a fairly quiet day on financial markets. It gives us a bit more chance to look at our exposures ahead of what is obviously the marquee event risk for the rest of the week. Now, that being the ECB meeting tomorrow at 9:45, ahead of the US CPI numbers, which come out at 10:30, and then at the back end of the week we've got the retail sales numbers. So for me, they're the epicenter of what is going to be event risk for us to navigate our portfolios through. The CPI numbers, which are generally take a back seat to the Fed to core PCE, but actually have promoted somewhat of a reaction in financial markets. So obviously, if you're running US dollar positions, gold, S&P, or any kind of US-centric assets, do keep an eye on what's happening there. The market's expecting headline to come out at 1.8% unchanged, and the core number to come out at 2.3%. I will say, though, that with the Fed funds and euro dollar market fairly well anchored ahead of that September meeting, it's unlikely, unless we see a big beat or a big miss, to invoke too much of reaction in those assets that I talked about there. The CPI, the retail sales numbers, obviously an important one for the Federal Reserve. They also want to know the life and the health of the consumer. But again, we're only expecting tepid growth from the consumer in terms of that retail sales number. And the control group element of that, which feeds directly into the third quarter GDP print, which we think is probably running around 1.8% at the moment. So something definitely to keep an eye on. In terms of the ECB meeting, well, the market expectations have been lowered. We've seen a number of hawkish members within the ECB, or sort of on that sort of more hawkish spectrum of the Dove-Hawk divide, trying to downplay expectations. And there was an article that has come out in Market News talking about whether or not we're actually even going to see quantitative easing coming out. Now, I think in terms of what's implied in terms of volatility, the implied volatility over the meeting, well, if you put that into the straddle pricing, the market's expecting about a 56-point move in either direction in euro dollar with a 68.2% level of confidence. So given that we're likely to see so much in terms of monetary policy actions, the fact the market's only pricing about a 50-60-point move is suggestive that we've had a good chance to discount there. We're not going to be surprised by too much. Now, given what we've been seeing, I think it's interesting to know what's probably being priced in at this stage. Now, I think the first point is what's going to happen to the deposit rate. The market's a bit split on this in terms of pricing. If you look at swaps, you can see there's a 44.8% chance that we get the deposit rate being taken down 20 basis points to negative 60. So there's a 55.2 probability that we see the deposit rate being taken down by only 10 down to negative 50. My gut says that we're probably going to see it being taken down to 10 to negative 50 basis points, which shouldn't invoke too much of a reaction. That's largely in the price there, as I say. In fact, the fact is that there's pricing an element of this going even lower. So you might see a bit of reaction, the euro, if they don't cut by the 20 basis points that is somewhat in the price. So definitely something to consider. Also, what's going to happen with tiering. Now, there's obviously a lot of capital parked on the ECB's balance sheet, which is being charged and penalised for holding those excess reserves there. And the European banking sector has been hit pretty hard on the back of that. Obviously, if you look at the tape in European banks, they've been sold off very hard. I mean, okay, they're fine. They've had a bit of a rebound over the last couple of weeks as we've been seeing a bit of a steepening in the German 2s10s curve. That's been a very positive venture for the European banks. The German 2s10s curve's gone up from about 16 basis points up to about 28 basis points. And it's something we'll definitely be watching around the ECB meeting. But what we need to see is whether they're going to look to tier the charge on the excess reserves there. And if they do, then that's probably in the price, but that will allow the banks to get better access to ONIA rates and not be charged so much. But it will impact their profitability in a positive manner there. The other issue, which I think is a big one, is what's going to happen with quantitative easing. There's a lot of conjecture around whether that actually be quantitative easing in the first place, but I think the market's probably pricing around 30 billion euros per month. Now, the duration is obviously something you'll be looking at, whether that comes out over a year, maybe longer, obviously whether that's tied with a stronger forward guidance around meeting their inflation objectives is something we'll have to see. But of course, the idea is we're going to see more quantitative easing, probably to the tune of about $30 billion. I think the reaction comes in the euro, and the best place to look for me is what's happening in the German 2s10s yield curve. If we see a steepening of the yield curve as they drive front-end yields down, I think that could be quite a good situation for both the European banking sector, but also for the euro. Euro Swiss has been one of my preferred choices. If you have a look at the euro over the last month or so, the euro has rallied against the Swiss franc and the Japanese yen. There's a bit of risk coming back into markets. Volatility has fallen. So I think if we see the reaction with front-end yields outperforming the back end, you could see the euro perform quite nicely on the back of that. Now, obviously, Mario Draghi, this is his 76th meeting in charge of the ECB meeting. Obviously, he hands over to Christine Lagarde, who's probably number one mandate will be creating or forging a stronger union between the capital markets and also the banking sector. But ultimately, this is Draghi's last meeting. He knows now what's being priced in, that the hawks have driven down expectations. He's his own man, though, and I think he's still very much in charge of what's been going on the Governing Council, and I think he has a chance to outperform. So looking at those euro exposures, the market's not expecting much. They're not expecting fireworks or big moves in euro. Mario Draghi knows what's being priced in. I've talked about the various factors there. Can he go above and beyond, or will he meet expectations? I think if he meets expectations, then the euro could rally quite nicely on the back of that and on the disappointment. But Mario Draghi is someone that you don't really want to mess with when it comes to these meetings. So for me, I would actually be reducing my exposures into this meeting, even if the market's not expecting fireworks there.